Hi, good evening all, and thank you so much for joining another new session. My name is Ashish Asthana, and today we are doing this exclusive session on risk management, how important it is managing your money, managing your risk while trading, right? So let us understand this from our technical research analyst, Mr. Nagaraj Shetty, who will be letting us know the insights of it and what are the key parameters that you should think before you start your trading, what parameters you should consider when it comes to risk management or money management, right? So Nagaraj, over to you.
Thank you, Ashish. Hi friends, this is Nagaraj, one of the technical research analysts at HDFC Securities Limited. Today we are going to discuss about the risk of money management in the trading. You know, risk and money management is one of the important aspects of the trading. Many people even don't know, even they do not follow properly, but this is very important thing. While you know that without doing any money management, without doing any risk management, if you are trading like that, you are driving the vehicle without the brake. Anything can happen, even it can disastrous to you also for your financial positions. Many people have lost money, huge money, only because of the lack of understanding about the risk or money management, or not to following or ignoring totally the risk or money management in the trading. So today we will discuss, we have a presentation. We will discuss about the point to point, how we can manage, what is the benefit, what are the importance, and what are the final goals of our trading by doing all these things. Let us start with the risk management in trading. What is money risk management in trading? Money risk management is a crucial element of the trading of the financial market, especially in the times of volatility. Volatility in the sense when there is a market going up, going down with a huge range, with a big range, you have to manage your risk properly. Unless otherwise, there is a higher possibility that you'll get stopped out, or you'll get your investment running out of the this thing. That is very important during the time of volatility than normal time. It is defensive concept that keeps you in a fund so that you can trade another day and supports profitable performance. On a basic level, it tells you to have enough new money to trade in the positions. As a trader, you have to have a churn your positions as good as possible, as fast as possible. If your money stuck in any of the positions without really managing the risk or this thing, you'll be stuck in a trading, and finally that will take long time to recover the losses, or you'll end up with the loss making trade. Risk money management is the difference between the success and or failure in the trading. Trading currently correctly is the 90%. See friends, there is no guarantee that what is a good ratio of the risk management. There may be a 70%, there may be a 80% or 90%. People will do the risk management up to 90%, which is a better, which is the best, excellent performance. But everything you cannot achieve this 90%. But normally we can take it as 90% is good management of your money or risk. Unfortunately, this is the fact that most people don't give enough importance, or don't wish to understand to implement. Once you have your money management under control, your discipline and psychology will ensure your success. So friends, we discussed what are the basics, why we required, and what are the important levels, and step by step we'll discuss, we'll continue. And in the next slide, we can move to this is the image of money management. This exactly shows how your money grows when you are managing your money prudently. So friends, in money management, initial element, which is one of the important element, comes is a risk and reward ratio. The risk reward ratio helps investor to manage the risk of losing the money on the trades. The risk reward ratio measures the difference between the trade entry point to stop loss level and sell take profit level. What is the risk reward ratio? When you are entering trade, when you have defined a stock, we want to buy or want to sell, You have to have a risk reward ratio. How much profit you are going to take from that position, how much loss you are going to bear if the particular trade doesn't go in your favor. That is the risk management. Because friends, while trading, when we are in a market, we are a potential of incurring unlimited losses, unlimited profits as well. But unlimited losses means very dangerous to our trading and even for our psychological trading activities also. We have to have certain planning. We have to have certain management of our investment, how we manage it normally during other course of actions. What we say, see, when I first we have to define whether I'm a trader, I'm a day trader, I'm a momentum trader, I'm an investor. If I'm a trader, what are my risk and reward? How much profit potential? If I made if I created the strategy, then I'll think that yes, I'm going to buy the stocks at 100. For example, I take at 100, I bought the stocks, and the 110 is going to be my target, price target, which is going to occur in a day or in the next 2 to 3 days at 10%. At the same time, there is no guarantee, even though looking at the technicals and other factors, there is no guarantee that your trade is going to be a favorable trade or a negative trade. If that trade doesn't move into your aspects, into your expectation, then what is going to happen? It will come down. If you are bought at 100 rupees, you are expecting 110 to be reached in a short period of time. If it doesn't move in your favor, then you have to have the losses has to be limited to the some extent. Means what? You are placing a stop loss at 95. Normally 1:2. 1:2 are the best risk reward ratios what we observe in the market, because even though twice you are earning, if you are losing once in between, that at the end of the day, at the end of the month or a year, when you're calculating your whole trading MIS, then at least you'll end up with some good profit because of this good risk reward ratio. That is the main thing. Comparing these two provides a ratio of the profit and loss, reward to risk. You simplify, divide the reward expected by the maximum loss. What are the, this is a simple thing that you can calculate. If I'm getting 10 rupees on a profit on the upper side on the long trade, I can afford 5 rupees, 4 rupees, 6 rupees to a loss of that trade. There is no ideal ratio, as I told you that general 1:2 is a commonly used ratio. The issue is how much money the trader willing to risk. That is the main important thing. 1:2 risk reward ratio maximizes the profit on winning trade while limiting the losses when trade moves against. Friends, when we start trade as a trader, as an investor, as a momentum trader, when we have a plan, you are trading so many times, so you are trading X number of times in a day or a week or a month. You have to have certain strike rate or success ratio. Let's take an example. In a week's time, if you have created 10 trades, including sell or buy trade, there is no guarantee that all the trend trade is going to be clicked. You are going to profit from all the trend trade. There is no guarantee. Even you may get, you may even in a good strike rate, even you may click your trades for 7 times. Even 7 of your trades will get your money, and 3 of trades will lose you. You will have to lose your money. On that time, if you are maintaining a 1:2 ratio, at the end of the day, when you calculate, you'll get a good return as per the concept. So we'll move to next slide. Position sizing. Friends, position sizing is what? Position sizing refers to the size of the position within a particular portfolio or the amount of the investor is going to trade. Investor use the proportion position sizing help to determine how many units the security they can purchase, which helps them to control the risk and returns. When you are a trader, when you are so many, see, there are so many stocks in the market. If you are a trader of a particular segment, you will come out with so many stocks. Let's take one person is a trader coming out with the 10 stocks. He is looking like, and he has a trade set up for the 10 stocks. Whether really he has to enter in the 10 stocks, or another person who actually trades in a one stock, he wants to put whole money in a one stock. Let's take an example of 1 lakh. The person who likes one stocks, who is investing a whole bunch of 1 lakh in a one stock, or the other person who invests in a 10 stocks or a 5 stocks. How the benefit? Because see, when your stock, when you bought a position that moves up, then moves into your favor, then everything will be in a win-win position. You'll be in a win-win situation, no doubt about that. When the particular stock moves in an opposite direction, then you will become worried about the trade. And there is no guarantee. So many things will actually lead the stocks to move up or move down, stock price to become volatile. There is no guarantee that when you have 10 stocks or when you have one stock, there is no guarantee that that stock will going to perform for the next few days, for the next few sessions, few hours, or for the next few weeks. There is no guarantee. When there is no guarantee, better to have at least position sizing. Shortlist the position. I don't say that you have to buy a 10 number of stocks at time, 5 number of stocks, 3 number of stocks. Depend on your investment, depend on the market conditions. You shortlist the number of stocks. At least rather than relying on one stocks to perform on your trade, at least you can have 2 or 3 stocks, 3 or 5 stocks. When you are having a 5 stocks in your trading thing, when at least 3 to 4 stocks moves up, then you'll make money on the trading. At least you can ignore that 1 or 2 stocks doesn't move in your direction. So this is the beauty of the position sizing. This is one of the elements of the risk reward management. Your position size, your trade size is more important than your entry and exit points when they're trading. You can have the best strategy, but if your trade size is too big or too small, either you'll take a too much loss or too lower risk. This is like taking a proper risk on your trading. If you're betting on a one stock when the whole bunch is going up, then you're risking the money little high. Or when you are taking 3 to 4 stocks, when the whole bunch is moving up, whole market is moving up, then your risk is very limited as compared to the previous strategy. So this is the one thing, position sizing. This is the image of position sizing trade. You have to wait your stocks before start of the trade. Pyramids of this trading success: entry, exits, psychology, money management, position sizing. So all the three, psychology, money management, position sizing, all the three comes together to become a better trader or a successful trader. Psychology, in the sense, the most people will say, I'll discuss small thing about the psychology. Most people will say we are trading as per the techniques, as per the principles of the charts. As being a technical analyst, I'm saying as per the other fundamental. If you are a fundamental, if you are following the fundamentals of the stocks, how the psychology comes into the picture. See, friends, everything is in a brain. The market moves, the market price volatiles, everything happens with the mass crowd psychology. If you are having one trade, if you have started one trade, created one trade, the trade is not moving as per your expectation, you'll become worried, and your psychology says that no, something is happening. Yes, I have to out of that stocks, out of that trade. You become out of the trade, then certain time moves up. Sometimes you enter into a trade, it triggers your stop loss and moves up. You'll become annoyed. Sometimes you refuse to place a stop loss on the because of 1 or 2 instances of whipsaws in the stop loss. Sometimes happens you are into a positions, it moves up, and you exit the position on whatever the basis on the this thing, and again it moves up to 3-fold, 2-fold of your exit points. Then again you become worried about what is happening in the market, why the market is not moving as per our expectations. All this mind game, all these psychological experiences can be controlled while doing some discipline in the training. And discipline is a position sizing. One of the discipline is a position sizing. Importance of stop loss. Friends, what is a stop loss? Everyone knows it's a universal truth in the trading. Stop loss. Many people understand the stop loss in a better way. Many people refuse to put the stop loss. Many people have a bitter experience with the stop loss. I think most people have a bitter experience with the stop loss. Actually, what is a stop loss? Stop loss, as per the order, better way you can know it. Once the trade is not moving as per your expectation, moves against your expectation, that level will be triggered, what you are placed as a risk. As I told you, you place a buy at 100, you bought a stock at 100, you're targeting 110 over the next few trading sessions or days or hours, and that trade doesn't move up, doesn't move according to your expectation, turns down, moves below the support, and hits the 105 as you put the stop loss. Once you put the stop loss triggered, then your trade will be out with the loss. That is the concept. Same vice versa for the short positions. When the stocks moves up and hits the stop loss for your trade, and you exit the trade. Initially, we find that these stop losses, sometimes these stop losses triggers and the stock price moves up, because the stop loss will be placed for a buy trade. Stop loss will be placed just below the support. For the sell trade, stop loss will be placed technically below the resistance. Most of the time it happens that it reaches the resistance level, it reaches the support level, and moves in as per your direction, but you are out of the trade. You become very annoyed. You are very annoyed. You have become worried about the trading. First, I'll tell you, you can manage the stop loss. You can place a stop loss as per the confirmation. What is the confirmation? Even last webinar I discussed with one of my friend. What is the confirmation? If you are a day trader, you are looking at 60-minute chart. You place the stop loss at 95. Then look at the 5-minute chart. If the stock price is nearing the 95, look at the 5-minute chart. Look at the 1-minute chart. Whether that 95 is holding, whether just clicking the 95, 94.50, the stock is showing some bounces at the 95, 96 level. Hold with the position with slight additional risk, for at least 1 rupee risk. And you can wait. Once it moves above, then you can hold it. We say the stop loss as per closing basis. It need not be a daily closing basis. As I told you, if you are a day trader, 60-30 minutes you are looking what? You are watching screens, then place stop loss as per 5 minutes, 1 minute, 5 minutes, 3 minutes, like that. If you are a day trader, sorry, if you are a momentum trader, you are waiting for the momentum to pick up in the next 3 to 5 days. Wait till the daily closing. At least you can derive, you can see at hourly time frame whether the stock is at the near the closing at hourly time frame, whether the stock is nearly closing below the stop loss time period on the short position or a long position. Be careful. If it is really moving below, then exit the position. Next day it will move opposite of your direction. This is the importance of the stop loss, where you can place by looking at the closing basis as per intraday, daily, time, weekly, or this thing. And if you don't follow stop loss, I think many people have seen disastrous in their portfolios, in their whole finances, only because of not putting the stop loss. Stop loss is a buy sell order which gets triggered automatically once the stock reaches a certain price. The aim is here to limit the losses on the security buy or sell positions. Stop order to sell becomes a market order when the item is traded or at the specified price. As I mentioned, stop loss enables to you to churn your money faster. Time, it limits losses so that you can live another day. This is like if you are a trader, you are prepared for the stop losses. You are prepared for the opposite trade. You are prepared for the your favorable trade as per your expectation. Once it moves beyond below your expectation, you exit out of the trade, and the money principal will be there. You are prepared for the next trade. As psychologically, you are a trader, a momentum trader, or you are an investor. You'll be prepared for the next investment. So it will help you to limit the losses and churn investment. Will be live for the another day. Your primary task is to close losing position. As I mentioned, when the position is not moving, then not to hesitate to have that position continue. Just exit the position. Either it's a buy position or sell positions into the another trade, or look compensate the bad trade elsewhere. For trader, the real turn on investment comes from the churning a capital as quickly as possible by moving out of the positions rapidly. Yes, obviously, once the trade is not for the day, then exit and go for a next one. At times, whipsaws in the stock price may mean that after hitting the stop loss, stock price again continues in the previous direction. As I mentioned, most of the time it happens because we place a stop loss at the resistance for the sell trade, for the support, below the support for the buy trade. At times, whipsaws the stock may mean that the hitting the stop loss, the stock again continues in the previous direction. However, it also means that risk of higher loss while protecting the pips of loss. Sometimes it happens because as I defined 95 is a stop loss. Once it moves below the 94, 94.50, after it gives a confirmation, maybe it gives you more little additional risk, but it is good for a long run. So friends, you can see that this is the result of not putting the stop loss from the chart. See, once the support level has been broken, how that stock price in the upper chart, how the stock price went and how much decline has happened over the period of time. This is how you can protect your investment, you can protect your principles. Staggered trade in the concept of risk reward management, staggered trade is another element which has some ups and downs. We'll discuss how the staggered trade happens. Staggered entry and exit strategy allows you to enter percentage of total number of shares to buy sell since the time of the decide to start of trade. Subsequent tranches of a trade can be executed with a gap of time or price both depending on the emerging technical or fundamental situation. What is staggering? Let's take you picked up one stocks, you are buying at 100 rupees, for example. Then rather than putting, you have 1 lakh capital for, rather than putting whole 1 lakh in one stock at one price 100, you can just take a risk. If the stock has moved above the support level, let's take it 101. You are very much eager to enter into that trade. You rather than putting whole 1 lakh at 101, you put 50,000 at 101. Wait for just below around 99 or 100 to enter into a next tranche of trade. When you are trading at the near the support level, there is a higher possibility that stock may come down to the support level and bounce back from the upper support. That's what it becomes. It comes into limelight that rather than entering into a full amount in one trade, stagger the trade. Friends, when you look at technically, when you look at higher tops and higher bottoms, the higher bottoms clearly indicate the staggering of the buying. Means that price moves up, price enters into a resistance mode, shows correction, finds the support, moves up and crosses above the previous high, becomes a new higher top, higher bottom, new higher top, higher bottom. You can really make money during such moment. Most of the time stocks moves in a higher top, higher bottom, or stocks move in a lower top, lower bottom. During your sell trade or during your buy trade, you can easily create a wealth by staggering the money rather than buying at one price at one level. You can buy it at the lower levels, buy on dips, which will get you into a quick success over the period of time. Such an approach should give you an opportunity to buy at lower levels in case there is a correction in the market, vice versa when you are in a short position. Also, it makes sense to add the buy positions as you gain confidence in the company, have seen its performance. Means if you look at the stock price, you have a confidence. Once it comes down to the lower level, you enter the second tranche of your investment and it moves up. It will give you more confidence rather than entering into a one trade. The downside of this approach is that the stock price moving in the desired direction before you have completing buying or selling. The another downside is like that you decide to buy at 101. Rather than putting 1 lakh, for example, you have invested 50,000. Sometimes it happens from 101, it moves up to 107. You'll be worried again that no, I have invested only 50,000. I should have invested 1 lakh thousand. I could have made a good huge profit from that position. It happens sometimes, even the vice versa for the short trading, but it's a part of the trading strategy. Regular profit booking. Regular profit booking is one of the important concept in the risk reward management. So firstly, you define yourself, you are a trader, investor or momentum swing trader. First, how much profit you want, just define that. Define that and how much or what are the intervals regularly you can take a profit. Sometimes what happens, volatile markets moves in a range. If you have bought at some point, it moves into a higher range and comes down to the lower range. Let's take 100 and 110 is a range of the market. Once it moves up from the 100, reaches to 110. If you are waiting for the 115 to happen, again it comes down to 102, 103 levels. Again it moves down to 101, 111, 112. Again it comes down to 115. During such times, if you are regularly booking profit at, let's say you book the profit at the immediate resistance around 110, you'll be pocketing the profit. It comes down to 103. You can even add it. Even you can regularly book it at 111, 112. Rather than waiting for a one direction, better to have a strategy, book periodically. Friends, I will tell you, whatever the money you book it, that will be for you. That you keep in a mind that whatever things you book it, that will be stayed for you. That's better to, rather than waiting for a longer target, have regular profit booking. It helps to reduce risk. However, on the other hand, the stock price continues in the intended direction, the profit regular can taking profits regularly can result in lower level profit. Sometimes it also happens. There is a drawback. This thing slightly negative for this concept is that you are thinking of a regular profit at 100 you bought 110, that was the resistance. You, for example, you exited the position at 110. It also happens that in the next 2 days it moves up to 120. Then you will become this thing, and array, I booked out so quickly that I could have waited at least for some other profit. I should have waited for a longer target. It happens, but most of the time, booking the profits regularly will help you in a long run. There are some tips of money management and trading rules to keep in mind. Just it's a tip, just you can mention it or you can memorize it. What should be the size of the each trade? You define before starting of the trade, what is your principal, what is the position you are going to get, how much can stagger. If you are have 1 lakh, for example, how much you can stagger, be preferred, means be defined before start of the trade. How many different trades one may carry at any point of time. As I told you, maybe a one or two trade, 3 trade, 5 trade, depending on the market, depending on the stocks and sector performance. What should be the proportion between the different asset classes? Depends on the how you are looking at the fundamentals, technicals, equity, debt. If you are looking, the equity is very volatile, very risk. Put limited money into equity. Put more money in a debt instrument or debt equity asset classes. How much leverage one you should depend on the trade, depend on the chart pattern of the stock. You can leverage or you can place your this thing amount of allocation. Diversification, concentration, you have to decide for yourself whether I'm going to concentrate on one stock, depend on the one stock, or a bunch of stocks, 3 stock, 5 stock, totally depend on the trade portfolio. You have to be defined, you have to be prepared for that before the start of the trade. Risk reward ratio, as I mentioned, 1:2 is a better ratio in under circumstances. When to take profits, definitely you have to take profits at regular intervals, and you have to be defined. When start of the trade, you have to target yourself. What are the target I'm going to wait for? Whether regularly booking or one-time target, that you have to define. Whether the profit should be taken at one time or spread, yes. What should be your individual stop loss? Stop loss you have to maintain, whether stop loss as per closing basis. Closing basis for a day trader, closing basis for a momentum trader, or weekly, monthly chart time frame. You have to define it before that. How much one should wait to check whipsaws. Whipsaws, as I mentioned, you have to filter the trade. A very critical element. Whipsaws in the stop loss, very critical element. You have to wait for the things to clarify before that exiting or entering into the trade with a smaller or large time frame correlation. Friends, these are some concepts on which trader or investor needs to have some clarity to help him build wealth over time. That's an end. Thank you, and now over to Mr. Ashish.
Thanks, Nagaraj. Thank you so much for such valuable inputs. And now we are open for Q&A, friends. Any questions you have, specific questions, you can please ask, and we'll be really happy to answer them. So let's see what questions we are getting. In the meanwhile, you're just typing the questions. Just wanted to inform you that now with HDFC Securities, we have also come up with bracket order and basket order, right? With a trailing stop loss. So please have a look. We have done an exclusive webinar on that last time. Within a day or two, the new video, the recorded video would be uploaded on our YouTube channel. And also I could see many questions that people have joined in late. They haven't, they missed the earlier part. Can they watch recording? So yes, recording would be available on the same link after an hour's time. And while opening, just select the mobile browser if you're watching from mobile, and you can access the recorded webinar after an hour's time on the same link. However, this video will also be available on our YouTube channel. So if you have not yet subscribed to our YouTube channel, just go to YouTube, type HDFC Securities, subscribe to our channel. Go to the playlist. Under the playlist, you will see a playlist of webinars. There you can see our earlier recorded versions as well. right? And even as I said, that stop loss, that bracket order, basket order, along with trailing stop loss, that functionality is now available online, and you can take advantage of it. So let's see the questions now. Okay, so this first question we are getting from Mr. Kumar. He's saying, how should I identify if I'm trading with my capacity is 1 lakh rupees, how should I identify how much risk, how should I manage that risk? This is the question which has been asked, I think, by one of our customers.
Okay, it's a simple, depend on the your risk and reward ratio. If you're looking for a 1:2 risk and reward ratio, and on the basis of the chart pattern, you are thinking that you are buying at 100 rupees and there is a potential target up to the 110, means 10 rupees you are thinking of a target. At least 4 to 5 rupees you have to place a stop loss, means you have to risk the 4 to 5 rupees. That is the ideal 1:2.
All right. So that's all for now, considering the time constraint. Stay tuned at 4:15 every day. We are coming up with some interesting webinars. Tomorrow again, we have Investment Ki Pathshala too. So do attend that, and post that again. We will be having many more interesting sessions coming up till this month end, right? So stay tuned. Thank you so much for joining in, and have a great evening ahead.